Welcome back to Morning Trade Live. I'm Nicole Petalides, live on the floor of the New York Stock Exchange, not too far away from the opening bell here. An exciting day, and of course, NVIDIA Day, and so much more to discuss. Joining me right now, it's our pleasure to have Cameron Dawson, Chief Investment Officer at New Edge Wealth. Nice to see you. I see you here many times live in person. We've never really gotten a chance to chat off camera here, but I'm glad you're on this morning because we'd like to pick your brain a little bit about the market action, Cameron.
Most definitely. Well, this has been a market that has still proven to be just utterly resilient in the face of a lot of uncertainty. People still very much wanting to buy the dip. And you see that in equity flows. ETF flows into equities, overall flows into equities have been extraordinarily strong over the last month or so. And that's interesting in a context of a market that is trading at a rather stretched valuation. So you have money chasing really strong returns, which we think could last through the end of the year. We think seasonality is strong in November and December. You get that performance chasing, you get window dressing, people not wanting to take capital gains recognition. And so what that just means is that potentially you see the chase into the end of the year. That might spell a very different story for 2025, though, as we think about stretched positioning, stretched valuations, and stretched sentiment.
Right. And you make a good point about the capital gains, right? People don't want to sell off some of their great names and say, wow, I made 20, 30, 50% on this stock and 100% on some of them. I mean, it's been an incredible time. There was also a run up into the election. Trump wins. We hit new highs across the board. We're waiting also on the Fed, and I'll get to that in a moment. But do you think that some of the incoming administration's business-friendly policies are already priced into the market? I mean, there was some reports this morning that he would like to implement tariffs and he would like to see the stock market at new highs. And he wants to pick a Treasury secretary that can really do both of those.
Yeah, it's a good question if you can have both, because when we saw the implementation of tariffs through 2018, of course, that coincided with the time that the Fed was tightening policy and removing liquidity from the market. But we did see it jar the market. The application of those tariffs certainly was something that was seen as a risk to the market and was even recognized as a risk by the Fed itself. And that was one of the things that led it to cut rates in the summer of 2019. So if we think about tariffs, we don't see it necessarily as something that wouldn't hurt. We see tariffs as a risk simply because they could add to supply chain issues, which could potentially exacerbate inflation. So we are watching very closely to see tariffs as a potential downside. And then what do we get on the upside? What is the positive tailwinds that we could see from this administration? A lot of people pointing to the potential for lower taxes. That's a question if we can achieve that given the slim majority of the House, as well as deregulation, and if that kind of causes a boom in things like M&A and overall corporate investment. The question is, how does that translate into corporate earnings? And the most interesting thing for us is that 2025 earnings have actually been getting trimmed over the last couple of months by about 2%, so not too much. But we think we have to watch that 2025 earnings number very closely, because if that continues to get trimmed, it suggests that maybe these kinds of policies aren't quite having an impact on the corporate earnings profit outlook.
Yeah, I mean, I think sentiment's a big deal on how people feel, because then that also, says how they will invest or how much they'll risk on trade, et cetera. That being said, you do like U.S. stocks more than international. I know that TJ Maxx, for example, parent TJX, noted some strength in Europe. But big picture, you prefer the U.S. over international in a big way, or is something changing in your opinion?
Nothing changing. This has been a stance of ours for quite some time, which is that we've continued to see much better earnings dynamics within the US, and we simply don't see valuation as a catalyst. So if you look back over the last 7 years or so, you could have argued that non-US stocks traded at a significant discount to the US and thus justifying having a higher weight. The problem is they've just kept getting cheaper. And so what we look to is the fact that overall earnings growth, earnings revisions have both been much more positive for US companies, which we don't necessarily see changing when we look into 2025. That doesn't mean that we avoid international stocks altogether. We think that there's a great opportunity for selectivity within international stocks. There's a big difference, a much bigger difference between the winners and the losers. So we think of all areas, that's an opportunity for active management to look at quality companies, to look at areas that have good balance sheets where we can choose those selective stocks, but certainly not something that we're making an argument to go overweight non-US at this time.
Yeah, understood. So what are you interested in now as far as investments, either near term or more longer term, 6 to 12 months or 18 months out? I know Bitcoin is something everybody's focusing on. I saw in your note you thought maybe that might be overbought at this moment. You have Tom Lee from Fundstrat who thinks it's going to 150,000 by the end of the year. So I'd love to hear your thoughts on where Bitcoin could be headed, coupled with any other sectors or particular investments that you think may be of value to our viewers.
Well, certainly. I think from the Bitcoin perspective, we just simply look at the technicals and identifying that it is technically overbought, but sometimes the rules don't apply in the realm of narratives. When it comes to looking for opportunities in this market, we think valuation discipline is absolutely critical. So what we're looking for is areas such as within the value index of looking for higher quality companies that still trade at a discount to peers. We think that looking for companies with strong free cash flow generation, strong return on invested capital, that those names have lagged over the last couple of months. You have seen a little bit of a risk on junkier beta rally in the last couple of months, but we think over the long run, taking advantage of those names that might sell off because they're not as high beta or high octane as what's leading the market today certainly will prove out to be winners in the end. So we look across sectors, we find opportunities in every sector to be selective in focusing on those quality names.
Yeah, we're getting more Fed speak, too. I know you're watching that very carefully. You noted some of the hawkish, leaning Fed commentary that has come out. What do you think the Fed should do?
Well, we were of the camp and have been of the camp all year long that they're not going to cut nearly as much as they thought they would or the bond market thought that they would. We've seen this economy as being more resilient or at least less sensitive to short-term interest rates compared to prior cycles, which just suggests that that neutral rate is higher this cycle. Now, of course, we could throw that all out the window if we see a sharp deterioration in the US economy, possibly because of some kind of exogenous factor. But what we'd point to is the fact that as long as this economy is holding up and is more resilient than expected, then we don't think the Fed will deliver on all of those cuts. It's good to remember the dot plot that they released in September has another 100 basis points of cuts in 2025. Right. We don't think we get there if this economy continues to deliver on this resilience that we've had really for the last 2 years.
Yeah, there are some people who are saying this is the end of the Fed cutting cycle. There are some who say it'll be December and that will be the end. And there are some who say it's over. Are you willing to get in any one of those camps?
Well, if you look historically, the last 3 times that the Fed cut and there wasn't a recession, they cut by 75 basis points. Now, of course, those were 1998, 1995, and then 2019. And so if we don't have a recession and there isn't this sharp weakening within the labor market, it suggests that between 75 and maybe 100 basis points, if we get that cut in December, could be all that they do. We talk a lot about how Chair Powell doesn't want to be Arthur Burns from the 70s and restoke inflation, but we can't forget the experience of 1998, where Greenspan cut interest rates 75 basis points, and it was followed by a massive equity bubble, a truly destabilizing bubble that saw very poor forward returns after the March 2000 peak. So that has to be something that is on their mind, given the fact that financial conditions are still very easy, very accommodative. And overall, this economy doesn't suggest that they need to step in and do emergency cuts, which just tells us that they're not going to do as much, which means that we could be much closer to the end of this cutting cycle, of course, assuming that we don't see some sharp deterioration in the labor market.
Yeah, Cameron Dawson, great to have you on, Chief Investment Officer, New Edge Wealth. I'll see you here on Wall Street, I'm sure soon enough. Thank you.